Bismillahirrahmanirrahim. Hello everyone. Today we are going to continue chapter 22, which is the master budget. In the last video, we stopped at the cash expected budget, and today we are going to continue from the direct labor budget. Direct labor budget is a budget that is telling me how much cash I'm going to pay in order to satisfy the direct labor needed for the production. As we said before, we started with the sales budget. Then we went to the cash collection, production budget, direct material budget. Today, we are going to prepare the direct labor budget and the manufacturing overhead and the other budgets. This example is telling me at Royal, each unit of product require 0.05 hours of direct labor. يعني each unit will take from me 0.05, which is 3 minutes of direct labor in order to complete 1 unit of the product. The company has no layoff policy, so all the employee will be paid for 40 hours of work each week. For purposes of our illustration, assume that Royal has a no layoff policy. Workers are paid at the rate of $10 per hour regardless of the hours worked. For the next 3 months, the direct labor workforce will be paid for a minimum of 1,500 hours per month. Let's go to prepare the direct labor. At the beginning, I'm going to ignore this part, which is the minimum 1,500 hours. It is something like the minimum wage rate أو الحد الأدنى للأجور, as we say in Egypt. خلاص. How to calculate the budget? I will say units of production. From where did I get it? From the production budget. If you remember, if you refer back to the part 1 of the videos of the chapter, okay, you will find that the production budget told us that we have to produce $26,000, 46,000, 29,000. From here, we are going to start to calculate how much labor do we need. He is telling me that we need 0.05 hours for each unit. So in order to produce the 26,000 units, I will multiply it by 0.05, which is the direct labor per unit, equal the total labor hours required. Pay attention, these are labor hours. Okay, and as I said before, if I'm going to ignore the minimum number of hours required, I will multiply this directly by the rate per hour. And he told me that the rate per hour is $10 per hour. So actually, I will multiply it right away by $10. And then the total labor cost will be $13,000 as we paid it by dollar rate, $23,000, $14,500. So if it is like that, I will stop here. So this is the total direct labor cost, the expected, of course. But in the question, in the given, he is telling me that I have minimum number of labor hours that the workers must be paid for. So I will continue at the original example and saying, he said that we have 1,500 minimum payment. So this month, the workers worked for 1,300 only. So I'm going to ignore that. And I will assume that the labor hours that will be paid is 1,500. In the next month, we actually worked for 2,300. Of course, all of those, again, are expected because we are talking about budget. But we are budgeting here that the number of hours will be 2,300. And the minimum to be paid is 1,500. So, okay, I will ignore the minimum as long as we exceed it. So I'm going to pay for the 2,300. Here, we are below the 1,500, so I'm going to calculate the rate based on the labor hours paid. If it is below the 1,500, I will calculate it based on 1,500. If it is higher, so I'm going to calculate based on the higher. So actually, again, this is the direct labor cost. What is the remaining? What is remaining is the manufacturing overhead. Because again, we said if we are going to produce a product, 3 main costs must be budgeted: direct material, direct labor, and manufacturing overhead. طيب, we did the direct material, we did the direct labor, let's go for the manufacturing overhead. طيب, at Royal, manufacturing overhead is applied to units of product on the basis of direct labor hour. For simplicity here, we are going to divide the manufacturing overhead into 2 main sections: variable one and fixed one. And as long as we are saying we have a variable part, it has to have what we call cost driver, the base that we are going to calculate the cost on. Here he said that the base is direct labor hour. So the variable manufacturing overhead rate is $20 per direct labor hour. The fixed manufacturing overhead is $50,000 per month, which include $20,000 of non-cash. And pay attention for that. I will be back for it later, but pay attention. 50,000, 20,000 of them are non-cash, primary depreciation. طيب, يبقى البادجت will include two main parts. What are the 2 main parts? The 2 main parts are the variable and the fixed. طيب, he said that the variable part is depending on the direct labor hour. So I went back to the direct labor budget, and again pay attention, I used the actual hours, those one. Why I didn't take those? Because those only for the sake of preparing the direct labor budget. So I will start here by the number of labor hours, the actual one, the 1,300, and I will multiply it by the variable manufacturing overhead rate, and this is given in the question, to reach for the variable manufacturing overhead. And then I will add the fixed part, which is also given in the question, to reach for the total manufacturing overhead cost. So this is the total manufacturing overhead cost. طيب, but actually I'm doing all of these budget in order to reach for the cash budget. So I don't need the total manufacturing overhead cost right now, but I need the cash disbursement, the amount of cash that will be paid. So I'm going to decrease or to subtract less the non-cash cost, which is also given in the question, which is $20,000, in order to reach for the cash disbursement. This is the actual cash we're expecting to pay for the manufacturing overhead. طيب, if I would like to get the manufacturing overhead per hour, this is the budgeted rate. I will take the total manufacturing cost, which is 251,000, divided by the total hours, which is 5,050. So the budgeted manufacturing overhead is 49.7. This one include the variable part plus the fixed part. Okay. Then I'm going to move for the ending finished goods inventory budget. Like, how much budget do we need? Actually, here I would like to get the cost per unit type, and the cost per unit will be direct material 5. Each unit needs 5 pounds, and each pound is costing me 0.4, so the total cost will be $2. Direct labor 0.05 hours multiplied by $10, which is 0.50. Manufacturing overhead 0.05 hours multiplied 49.7, which is 2.49. So the cost per unit, the expected cost per unit is 4.99. Right. The budgeted finished goods inventory is how much ending inventory on unit do we have, and we will get it from the production budget, the end of the quarter. I will multiply it by 4.99, so the ending finished goods inventory is 24,950. The next step is we finished the production cost budget. Then I will move to the operating cost budget, selling and administrative expense budget. Type at Royal, the selling and administrative expense is divided into variable also and fixed. The variable part are administration cost 0.5 per unit sold. So the base here is the unit sold. This means that I'm going to get the number of units expected to be sold from the sales budget at the beginning of the chapter. The fixed one is 70,000, and it includes $10,000 depreciation cost, which is not cash outflow, and it will follow the same manner of the manufacturing overhead, which means I will start by the budgeted sales. Why budgeted sales? Because in the question he said that the base here is the number of units sold. يبقى budgeted sales multiplied by variable selling and administrative rate, which is equal variable expenses, plus the fixed part, which is the 70,000. So the total selling and administrative cost is minus the part that is not cash outflow, which is equal to the cash selling and administrative expenses. This is the amount that we are going to, are we expecting to pay for cash for selling and administrative. Now we already reached بقى for our main objective, which is the preparation of the cash budget. The cash budget is divided into 4 sections. Cash receipts, and this will come from the cash collection. Cash disbursement, which is coming بقى from many, يعني starting from cash disbursement for direct material, direct labor cost, manufacturing overhead, selling and administrative, and other payments if there are any. Cash excess or deficiency بقى, I'm going to subtract cash collection from cash disbursement. Any excess will be invested. Any deficiency will create the need to borrow to borrow money, and then I will see from where should I borrow and how I'm going to pay whatever I borrowed. طيب. Assume the following information for Royal Company. Maintain 16% open line of credit for 75%. يعني I made an agreement with the bank that I can borrow up to 75,000 with 16%, and pay attention again. 16% is annual interest rate. By default, whenever there is an interest rate, it is an annual interest rate. It is an annual interest rate. This is the default of saying the interest rate or stating the interest rate. طيب. Maintain a minimum cash balance of 30,000. يعني the company plan to keep a $30,000 in its safe as a minimum requirement. طيب. Borrow on the first day of the month and repay loan on the last day of the month. Pays a cash dividend of 49,000 in April. All of those are expectation, of course. Purchase of 143,700 of equipment in May and 48,300 in June. Both purchases paid in cash. And we has an April 1st cash balance of 40,000. Coming, of course, from March 31st. طيب, let's go. I will start here by beginning cash balance. We have 40,000 from March. And then I'm going to add the cash collection. From where should I get it? From the schedule of expected cash collection. The second budget that we did. Equal to, this is the total cash available that we have. Minus, subtract the cash disbursement. All بقى the cash disbursement that we have. The material, the labor, overhead, selling and administrative, equipment purchase, we don't have here, dividend, and it was given in the question, and then I will get the total cash disbursement. Now I'm expecting that I'm going to receive 210, I'm expecting to disperse 230,000. So I have a deficiency of 20,000. Why deficiency? Because the total disbursement is bigger than the cash collection, or the total cash available. طيب, يبقى I need to finance that. طيب, I'm going to borrow 50,000. Why I'm going to borrow 50,000? Because in the question he said that we have to keep a 30,000 minimum cash balance in the company. So we are in short of 20,000 and we need another 30 to be kept in the company. So I have to borrow 50,000. So I'm going to cover the 20 and the remaining, which is the 30,000, will continue with us for the next period, which is May. I will start by the 30,000 coming from here. And then I will add again the cash collection for May to reach for 430,000. I will start subtracting the cash disbursements again to reach for 400,000. Type. I have an expected cash in 430, cash out 400, so I have an excess of 30,000. Type. Shall I think to repay what I have borrowed before? No, because you don't have enough cash. This 30,000 is almost enough for the minimum cash balance, so nothing to be done here. And I will go for June بقى. June, my expectation for the cash in is 365,000. My expectation for the cash out is 217, so I have an excess of 95,000. So I have here a plenty of cash, much cash. I will start to think about repaying the 50,000 that I have borrowed. So I will pay, between brackets is minus, which I paid the 50,000. Type. And then this money has a cost, which is the interest rate. And in the question he said, whenever we borrow at the beginning of the month and we repay at the end of the month. So in order to calculate the period that we borrowed the money for, this is one period, second period, third period, 3 months. يبقى 50,000 multiplied 16%, which is the rate, multiplied 3/12. Why 3/12? Because 12 months, it is for a year. This is why I said 16,000, an annual interest rate is for 1 whole year, and we borrowed the money only for 3 months. So actually the 50,000 multiplied 16% multiplied 3/12. Okay, which is 2,000. But I will pay the 52,000 and the remaining will be 43,000 that will continue with us for July whenever we are going to prepare the budget for July. But this is the cash budget. This is the cash budget. Okay. Now we completed the cash budget. Another interesting part of the chapter is the budgeted income statement. Budgeted income statement. And actually the budgeted income statement and the budgeted balance sheet will depend on what did you expect, which means you are going to say here that the income statement, we have $1 million. From where did I get the $1 million? From the sales budget. Refer back بقى, okay, to the budget, the 3 months that we did, which is ending June 30, the total sales expected was 1 million. Minus cost of goods sold, which is the inventory that we sold, the 100,000, multiplied by the cost per unit, and we calculated before. Gross profit minus selling and administrative, again from selling and administrative expenses, equal operating income. Minus cost of goods sold equal gross margin, minus selling administrative equal operating income, minus interest expense, which came from the cash budget, so it is net income, which is 239,000, based on also the sales that we have made before. Type. What about the budgeted balance sheet? Type. The budgeted balance sheet includes some judgment. Okay, this is why Roya reported the following account balance prior to preparing its budgeted financial statement. Land is 50,000, common stocks 200,000, retained earning is as shown, equipment, and so on. Actually here, this is we call judgment approach, which means it depends mainly on the judgment of the finance manager or the accountant. Okay, this is why this amount will be plugged in. Some of them, like the raw material or the account receivable or the finished goods inventory, or the accounts payable, those are coming from the budget that we have prepared, but the remaining of the numbers are judgmental numbers. Maybe I'm going to assume that the previous quarter was less than or more than 50,000, but we intended to do some action like selling a land or buying a land. So here this number is to be plugged in based on the judgment of the management. This is why we are not depending so much on that approach, because it is not that effective. By that we ended chapter 22, which was the master budget. Okay, and see you again inshallah in other chapters from our syllabus.